Did you know that small business owners miss out on billions of dollars in tax savings every year? It's true. According to the IRS, an estimated $1 trillion in tax deductions goes unclaimed annually. That's money that could be in your pocket instead of Uncle Sam's. But here's the thing. Most people don't even know these opportunities exist. They think tax savings are only for big corporations or the super rich. The truth? There are secret strategies that small business owners can use to legally avoid taxes, and you don't need a fancy degree to understand them. In this video, we're diving into 12 powerful, yet often overlooked, tax-free setups that can save you thousands. We're talking about everything from setting up shop in zero tax zones to using cryptocurrency in ways that keep your profits tax-free. We'll also explore how donating to charity can actually boost your bottom line and why offering stock options to employees might be the smartest move you make this year. Ready to learn how to keep more of what you earn? Stick around, because these secrets could change the way you think about taxes forever. Let's get started. Chapter 1: Zero Tax Zones. Setting up shop in strategic locations. Did you know there are places you can set up your business that offer zero or very low taxes? It's not just offshore islands. Several states and regions in the US offer tax incentives to attract small businesses. For instance, South Dakota and Wyoming have no state corporate income tax at all. That's a huge deal if you're looking to save on your tax bill. By strategically choosing your business location, you can cut down on your tax burden significantly. These zones often provide additional incentives like grants, subsidized training, and lower regulatory burdens. The key here is research. Understand what your state or country offers and weigh it against your business needs. Some entrepreneurs even consider relocating for these benefits. A study from the Tax Foundation in 2021 highlighted that states like Florida and Nevada are becoming increasingly popular for small businesses due to their tax-friendly environments. But don't just pack your bags and go. You need to consider the full cost of living, labor market, and logistics. A zero tax zone might sound like paradise, but you must ensure it aligns with your overall business strategy. Remember, it's not just about saving on taxes, it's about setting your business up for long-term success. Chapter 2: Double-dip deductibles. Maximizing benefits through personal and business integration. Here's a strategy that's all about making your expenses work for you. Did you know that if you run a business from home, you can deduct a portion of your home expenses? We're talking about mortgage interest, utilities, and even home repairs. This is a great way to maximize your deductions and reduce taxable income. This strategy isn't just for home offices. If you use your personal vehicle for business, you can deduct the mileage or actual expenses like gas, maintenance, and insurance. It's like getting rewarded for what you're already doing. According to the IRS, in 2022, the standard mileage rate was 58.5 cents per mile for business use. That adds up quickly. A lesser-known tactic is the Augusta rule. This allows you to rent out your home for business purposes for up to 14 days a year without paying tax on the rental income. Imagine hosting a business retreat at your home, then writing off the income. Integrating your personal and business finances can be tricky, so keep meticulous records. The more organized you are, the more you can take advantage of these tax breaks. Chapter 3: Tax-free trust tactics. Shielding wealth through family trusts. Trusts aren't just for the super rich. They're a smart tool for small business owners too. A family trust can help you protect your business assets and reduce your tax liability. It's like setting up a protective barrier around your wealth. By placing your business in a trust, you can separate your personal assets from your business, reducing your exposure to creditors and legal challenges. There's also the tax advantage. Trusts can distribute income to beneficiaries who might be in a lower tax bracket, which means less overall taxes paid. A report by the Congressional Research Service in 2020 found that properly structured trusts can significantly reduce tax obligations. This is particularly useful if you want to pass your business to your children without incurring heavy taxes. Setting up a trust requires expert advice. It's not something to DIY after watching a few videos online. But the potential savings and protection it offers are worth the effort. Remember, the goal is to build a legacy, not just a business. A trust ensures that your hard work benefits your family for generations. Chapter 4: Silent Partner Profits. Leveraging joint ventures for tax efficiency. Joint ventures aren't just about sharing the workload, they can also be a smart tax strategy. By bringing in a silent partner, you can inject capital into your business without giving up control. This can also open up new tax planning opportunities. Silent partners typically don't take an active role in day-to-day operations, which means they might be in a lower tax bracket than you. By structuring the partnership correctly, you can distribute profits in a way that minimizes taxes for both parties. This approach is particularly beneficial in high-tax environments. A study by the National Bureau of Economic Research found that partnerships and joint ventures are becoming increasingly popular as businesses look to optimize their tax positions. You're essentially creating a win-win scenario. Your partner benefits from investment returns, and you benefit from the tax efficiencies. But be careful with how you set this up. It's crucial to have a clear agreement in place that outlines how profits and losses will be shared. Misunderstandings can lead to disputes and costly legal battles. The key is transparency and planning. With the right setup, a joint venture can be a powerful tool for growth and tax savings. Chapter 5: Digital Nomad Loopholes. Running a global business from anywhere in today's connected world, where you run your business can be as flexible as you want it to be. Digital nomads have taken full advantage of this freedom, operating businesses from anywhere in the world. This isn't just about lifestyle, it's a savvy tax strategy too. Countries like Estonia, Portugal, and even Bali offer digital nomad visas with attractive tax benefits. For instance, Estonia's e-residency program allows entrepreneurs to establish and run an EU-based company remotely, while potentially paying zero taxes in Estonia if your revenue is earned outside the country. A 2020 report by MBO Partners found that 10.9 million Americans describe themselves as digital nomads, a 49% increase from the previous year. The trend is clear. More entrepreneurs are seeking out tax-friendly countries to base their businesses. The beauty of this strategy is that you're not tied down to one location, meaning you can choose a jurisdiction that offers the best tax advantages. However, this isn't a one-size-fits-all solution. You'll need to carefully consider the tax laws in both your home country and the country you're planning to operate from. Double taxation agreements, residency rules, and tax treaties all come into play. But with the right planning, running your business as a digital nomad can be a game changer for your tax situation. Chapter 6: Charitable Champion. How giving back can give you tax breaks. Here's a heartwarming way to reduce your tax bill: donate to charity. Not only does this help causes you care about, but it also provides significant tax benefits. According to the IRS, you can deduct up to 60% of your adjusted gross income through charitable donations, depending on the type of contribution and the organization. That's a substantial chunk of change. But it's not just about writing a check. Consider donating appreciated assets like stocks. By doing this, you avoid paying capital gains tax on the appreciation, and you still get to deduct the full fair market value of the donation. For example, Warren Buffett famously donates billions in Berkshire Hathaway stock to charity, leveraging this exact strategy to maximize his tax benefits while supporting important causes. Setting up a donor-advised fund, DOF, is another powerful tool. With a DOF, you can make a charitable contribution, receive an immediate tax deduction, and then recommend grants from the fund over time. It's like having your own mini foundation, but with less administrative hassle. This strategy gives you flexibility in your charitable giving while still reaping the tax benefits up front. Loving the content? Subscribe and let's jump right back into the action. Chapter 7: Legacy Loopholes. Transferring wealth and avoiding taxes. Thinking about passing your business to the next generation? The process can be daunting, especially when you consider the potential tax implications. But with smart planning, you can transfer wealth without getting hit with a huge tax bill. One powerful tool is the Grantor Retained Annuity Trust, GRAT. This allows you to transfer assets to your heirs while paying little to no gift tax. The magic of a GRAT lies in its design. You transfer assets into the trust and receive an annuity over a set period. At the end of the term, any remaining assets in the trust go to your beneficiaries. If the assets appreciate more than the IRS's assumed interest rate, the excess passes to your heirs tax-free. It's a win-win. According to the Tax Policy Center, GRATs are one of the most effective ways to minimize estate taxes. Another tactic is making annual exclusion gifts. In 2023, you could give up to $17,000 per person per year without incurring gift tax. If you start early, these small gifts can add up over time, allowing you to transfer significant wealth tax-free. The key is to plan ahead. By taking advantage of these strategies, you can pass on your legacy while keeping Uncle Sam's cut to a minimum. Chapter 8: Green Incentives. Eco-friendly tax shelters for sustainable entrepreneurs. Going green isn't just good for the planet, it's great for your bottom line too. Governments worldwide are offering tax incentives to businesses that adopt sustainable practices. In the US, the Federal Business Energy Investment Tax Credit, ITC, offers a 26% tax credit for solar, wind, and other renewable energy installations. That's a significant reduction in your tax liability, and it helps you do your part for the environment. But the benefits don't stop there. Installing energy-efficient equipment, like LED lighting or high-efficiency HVAC systems, can qualify your business for additional deductions. The Section 179D deduction, for example, allows for deductions up to $1.88 per square foot of space in buildings that meet certain energy efficiency standards. Interestingly, businesses that invest in electric vehicles, EVs, can also cash in on tax credits. The Clean Vehicle Credit, as of 2023, provides up to $7,500 in tax credits for purchasing qualifying EVs. And let's not forget about state and local incentives, which can stack on top of federal benefits, making green investments even more attractive. Sustainability isn't just a buzzword. It's a practical strategy for cutting costs and reducing your tax bill. Plus, it positions your business as a forward-thinking leader in a world that increasingly values eco-conscious decisions. As the world continues to focus on climate change, the incentives for going green are likely to grow, making this an excellent long-term strategy for any entrepreneur. Chapter 9: R&D Relief. Uncovering hidden credits for innovation. Innovation doesn't just drive your business forward, it can also drive down your tax bill. The Research and Development, R&D, tax credit is one of the most underutilized incentives available to small businesses. Many entrepreneurs think it's only for big companies with labs and scientists, but that's a misconception. If you're creating new products, improving existing ones, or even developing software, you might be eligible. A 2020 report from the National Small Business Association revealed that only 5% of small businesses take advantage of the R&D tax credit. That's a lot of money left on the table. The credit can cover up to 20% of qualifying R&D expenses, which includes wages, supplies, and even contract research. That's real cash back into your business. Interestingly, startups can use the R&D credit to offset payroll taxes, which is a huge benefit if you're not yet profitable. According to IRS data, more than 16,000 small businesses used this credit in 2021, saving an average of $25,000 each. So, if you're innovating, you're potentially sitting on a gold mine of tax savings. But, as with anything involving the IRS, documentation is key. You need to keep detailed records of your R&D activities and expenses. This isn't just about compliance, it's about maximizing your credit. A good accountant or tax advisor can guide you through the process and ensure you're getting the full benefit of this valuable incentive. Chapter 10: Artful Asset Management. Using fine art and collectibles as tax-free investments. Art isn't just beautiful to look at, it can also be a smart tax strategy. Investing in fine art and collectibles can offer significant tax advantages, especially if you know how to manage these assets wisely. The art market has seen explosive growth in recent years, with some pieces appreciating faster than traditional investments like stocks or real estate. One of the key benefits of investing in art is that it can be a tax-efficient way to grow your wealth. If you hold the art for more than a year, it qualifies for long-term capital gains tax rates, which are lower than ordinary income tax rates. Additionally, if you donate art to a charity or museum, you can deduct the fair market value of the artwork from your taxes, just like with other charitable contributions. According to a 2021 Deloitte Art and Finance report, the global art market is estimated to be worth over $50 billion, and many investors are turning to art as a way to diversify their portfolios. But art isn't just for the ultra-wealthy. Even small businesses can benefit by incorporating art into their investment strategy. Plus, you get to enjoy the art while it appreciates. One strategy is to create an art investment fund within your business. This allows you to pool resources with other investors, spreading the risk and potential rewards. But remember, the art market can be volatile. It's important to work with experts who can help you navigate the complexities of buying, holding, and eventually selling art in a way that maximizes your tax benefits. Your support means the world to us. Subscribe now to keep the content coming.